sizing option trades to avoid blowups in crazy markets. And my name is Eli. I'm a professional option trader. I manage over $8.7 million. And in this video, I want to talk about basically the management, position size, and stop losses. And I will go into very details about triangles and short puts, specifically for commodities, and how we can make it pretty much blowout proof. And we have a few more things to go over. So volatility correlations is also a big thing. Now, this is real life trading, no BS, no paid courses, no paid memberships. And let's get on. Now, if you are interested in mentorship, I do provide that service because I've been asked for it from quite a few people. Now, I only work with up to 15 members. There's no upfront cost. It's performance based only. So I have some skin in the game. And obviously, it's just going to make sense for everyone this way. If you're interested, just email me and we can see if we are a good fit for one another. Now, for the management, position size, and a few more things, I want to talk about first for everything for a short strangle. So if you want to avoid a blowout, you have to take profits at 25 to 50% of credit received, ideally 50%. And this is a big thing. For stop loss, it has to be 50% of credit received. It can go up to 75%. But I found that the sweet middle is 50% for most short strangles. Now, if you open a short strangle very far out of the money, then this might be a bit different because you're taking, basically very little credit in and a lot of risk. So usually it's best to stay within the maybe 10 to 20 delta area for short strangles. Now, the stop loss orders are only available in interactive brokers, just so you know, for futures options specifically, which is what I specialize in. So important to keep the stop loss at 50%. Some people can go up to 75, but I would keep it at 50%. Now, for the position size, I will only ever collect up to 8% of my total account capital and premium, and we will go over a live example in just a moment. This basically means if I have a $100,000 account, I will only ever collect up to $8,000 in premium. And if my stop loss is at 50% of that, then I'm risking at most 4% of my capital per position. And I only ever hold 1, 2, 3 positions open at a time, usually two positions at a time. And so this is kind of like the benchmark for the position size. So you'll never want to go over that. Now, there's another something really important with margin requirements, which we'll go over in a second. For now, for the short puts, kind of the same thing, take profit at 25 to 50% of credit, ideally 50%, and stop loss is at 50 to 75% of credit received. And I know a lot of people and you watching might also have the situation where you had a short put, it was down 100%, 150%, and then recovered and you ended up profiting. Well, if you want to avoid blowups, I would keep my stop loss pretty tight. Yes, it might mean you will have a bit more losses, but you will completely eliminate those massive drawdowns, which is ideally, which is not ideal, which is an absolute necessity if you want to be successful in this business. You have to look long term. And just take the losses at 50 to 75%, keep your losses small. And obviously you need to have a positive expectancy, which most people already do. But the biggest thing is the stop loss and the position size. So for short puts, I will only collect up to 6% of my total account capital and premium, just because this is a directional position and things can go against you much quicker than as opposed to a short strangle. Now, I will always exit positions if there's less than 21 days to expiration due to gamma risk. And this is a big one now to avoid basically most blowouts. And there will be another slide on volatility correlations in a moment. But I will exit positions, or I will exit a position if there are major critical news that moved the price. So basically fundamentals have shifted. And I will give you exact examples on what I mean when we go over the charts, and you'll see exactly how simple it is and how many times you could have saved yourself a lot of stress and money. Another thing is no rolling options. Usually when things go really bad against you, I would never roll options. I know a lot of people kind of keep rolling forever. This is not the professional way to do it. You need to know when to be out of a battle and when to stay in it. So usually taking a loss at 50%, 75% on the long term is way more efficient and profitable as opposed to rolling options, because at that point you're just trying to save a losing positions, which sometimes it works, sometimes it's just going to keep getting worse and worse. Now this is the biggest thing. This is where everyone is failing, and it is margin requirements need to be up to 30% of the account per position. This is where people can open massive positions, or if sometimes they can open a small position, and if the price moves against you, margin requirements get inflated to over 30% of the account, and at that point they might just run out of margin or out of liquidity to be able to hold the position open. But most people take too big of a position and they just don't care about margin requirements. They end up using 70-80% of the total account in margin requirements, sometimes per one position or sometimes two very correlated positions, which is my next topic, the volatility correlations. So important thing to understand is correlations, rises, volatility rises, and this is extremely important to take into account. It just means that when things go crazy, if you remember April 2nd, when Trump revealed some tariffs, everything reacted the exact same way. Everything went down, and this just tells you when correlations rise, when volatility rises. Correlations rises, volatility rises, and it's really important to kind of put your finger on it. So correlations also change depending on the state of the economy. So sometimes you can have gold and silver really correlated, sometimes they're not as correlated, but this is really important to understand. So what is volatility correlation? Again, it's when a major event causes different products to react with a big price move. The price can move in the same direction or not, it doesn't have to be. The point is, when something big happens, product A and product B, or position A and position B, they react with the volatility. Might not go to the same direction, but they do react with volatility, which is something we don't want. We want to avoid volatility usually when we sell options for most of the time. Now, when a major volatility event takes place, correlations rise to 1. We already talked about this. Gold and silver have close correlation, and I only ever trade one of them at a time. Now, sometimes they don't have as much correlation, but still, if something crazy happens, if there's a new conflict, they usually move in tandem when there's a big volatility event, right? So crude oil and gold have strong volatility correlation when geopolitical events take place or are ongoing. So under normal markets, gold and crude oil don't have much volatility correlations. But the past few years, since 2022, even 2021, gold and crude oil had some pretty strong volatility correlation. So this is also another thing to remember. And at the end of the day, your job as a trader is to recognize and understand when correlations rise and fall. And it is much, much easier than you think. If you spend your time looking at markets a few times a day, you'll get a feel for it. And again, I trade futures options, so it's much, much simpler than stocks, for example. But these are the major things. Now let's go over a few examples. Let me show you how I would size a short triangle on crude oil. So I just go ahead and sell a short triangle just outside the expected move. And let's say, for the sake of example, I have a $100,000 account. Now this is a demo account, so I can execute a trade if we need to. So for this trade, we can receive about $1,500 or almost $1,600 in credit, and the margin requirements are $4,600. So let's go and bump it up to maybe 5 contracts. So with 5 contracts, we're looking at a credit of $7,900 or a margin requirement of $23,000. Now, technically I can add another contract, or a lot of people will go ahead and add a few more contracts. At this point, you collect too much credit, you have too much exposure, and your margin requirements are over $32,000. So I will keep it probably at 5 contracts for every $100,000. Here I'm collecting basically $8,000, which is my upper limit of how much credit I want to collect, and only $23,000 in margin. This is pretty simple, pretty self-explanatory. If it's a short put, let's just go ahead and remove the short call over here. If it's a short put, we're looking at $27,000 in margin, and this is how much we get in credit. So in this case, I will not try to get more credit because I don't want to go over the $30,000 limit, which is what usually happens. People just want to collect more and more in credit, and they completely avoid the margin requirements. Now, some brokers have really, really small margin requirements, especially in the US. I'm here in Canada, so it's a bit different, and margin requirements are a bit higher here, which is, I think, is a good thing overall. So if you're in the US, you probably even want to keep it, up to $25,000, for example. But again, 30,000 is a pretty safe number, regardless of where you are in the world. And that's pretty simple. And this position size alone will save you so much money, because even if things go completely nuts, you'll be down what? Let's say you're down 100% of credit, then you'll be down 3.4% on your account, which is, it's not a big deal, right? If all hell breaks loose. Obviously, we want to keep it at a much smaller loss, preferably up to 50, just half of this. But things can happen, and markets can react in different ways. So you want to make sure you don't have a lot of credit and you don't have a lot of margin requirements, because these can really inflate really quickly and get you out of the position, or get a margin call. These things happen. Now, let's take a look at what you can actually do outside of position size to basically eliminate those crazy losses because of big market moves. Now, it's going to be a bit more specific for every single product. I'm going to give you 3 examples: wheat, copper. These are my personal examples of trades that I've been at, and I've took a small loss on them. And also what happened on April 2nd, which I was out of the market by April 2nd, of course. So with wheat, this is a position I opened on February 2024. So it was a short strangle, and the days kind of went by. Everything was fine for the most part. The position was kind of up and down. And then we reached, I think it was this day over here, or the next one. Let's see here. No, it wasn't this one. It was a big spike up. Let's see here. And we have one more. There we go. There was a big spike over here. And basically the price moved 3.66%, which is quite a lot. And what happened on this day is news came out that Russia are going to stop their deal where they let Ukraine export wheat through the Black Sea, because obviously this is while the conflict between Russia and Ukraine is ongoing. So if Russia is going to do it, there will be much less wheat supply to the world, and obviously if supply goes down, price will go up, and assuming demand stays the same, right? So this is basically like a red flag. And I know a lot of people don't want to read news, and it seems complicated. It's really not, and it's a very, very important thing in any kind of trading or investing. You have to understand what's going on with the product you're trading, right? So this is a simple thing, and I exited at the end of this day for a little loss. I think it was 10 or 15% of credit, because the position was going on for such a long time, and then the price went up, and volatility also shot up quite a lot. And because I kept my position size pretty small, I don't remember how much I lost here on this position, but it was a percent, maybe 1.5%. It was a very little. I think it was even less than 1% actually. So it was a pretty good play for myself. Now, another example I can show you very similar is actually with copper. Also another trade that I've done last year, actually around the same time, funny enough, but it was for a different reason. So let me just cut it here so we can see what happened kind of day by day. So I opened a short strangle. The price of copper was going sideways for quite a long time. It was a good volatility. I entered a short triangle right over here. And then a few days gonna go by. And then I think it was, let's see here, not this day, maybe the next, here we go. So on this day, I exited the position. It was a big price move and even a bigger volatility expansion. And if you just kind of go over the news, and I look at the news just right over here, it says everything you need to know basically. So what happened is, one, I think the second largest copper mine in the world had some difficulty, and it was reported that it basically collapsed on its own, or collapsed on itself. So if the second largest, biggest copper mine in the world collapsed, even though it might be false, right? Sometimes those reports come out and then they're up and going quite quickly. But for me, it's not there's no way for me to verify if it's going to be a big kind of collapse or not a big collapse, or if it has been a big collapse or not. All I know is there's a potential for a pretty big supply disruption. So price can just go up and up and up, right? So I exited the position right here, also for a small loss. And obviously it ended up being quite a massive closure that took multiple months, and the price of copper just kind of kept going up and up and up and up because the mine has been shut for quite a while and supply was damaged. Now, if we fast forward to see here to what happened on April 2nd of this year, 2025. See here, shut it off here. There we go. So April 2nd, 2025. You can see the price, or I guess the price dropped the day after, and it kind of kept dropping, and a lot of people lost a lot of money because of the tariffs. And the thing is, this event was known to everyone way ahead of time, right? So a lot of people just didn't think to exit their positions, right? Because when things like that happen, you don't know how the market will react. You do know there is a high chance it will be volatile, maybe to the upside or to the downside. I'm not sure. In this case, it was to the downside. But at the same time, this is not a risk worth taking. So you can just exit this position, or on the first day that the price dropped, you can also exit the position. A lot of people didn't because nobody wants to take a loss. Everyone wants to hold on and hope it was going to be fine. And what happened the day after, price kept going down. Some people still had like very far out of the money puts, for example. The problem is they were too big of a position size, where they were just out of liquidity, and they were forced out of the position by their broker because they were basically out of liquidity. The unrealized loss was too big and the margin requirements got inflated, right? And they might have a pretty small position on the S&P or on the ES, but at the same time, if you look at any other product on April 2nd or April 3rd, April 4th, everything went down. Everything, you can see here, everything just kind of went down, right? This is what I mean by correlations rise when volatility rises, right? So you have to keep that in mind. And if there's a big event that might be moving the entire market, everything, or that has an effect on everything that's has been traded, you have to take that into account and exit all positions regardless. This is how you protect your capital. This is how you avoid those massive drawdowns. You have to read the news, and you have to keep your position size, what I showed, or even smaller. Some people can keep the position size even, half of what I showed in this video, or even less, which is completely fine. But as long as you don't go over the 8% premium in strangles and 6% premium on short puts, and you take the loss when you're supposed to, you'll be fine. And again, you have to read the news. So this is pretty much it. Let's go to the final and last slide. To conclude this video, I want you to stay focused and patient, and remember that fortune favors the patient, especially in the markets. If you're trading or investing, you have to be safe with the markets. Otherwise, you will have pretty big drawdowns. You will lose everything, and you will eventually quit. Now, second thing is keep position size within the parameters that we showed this video, and uncorrelated as much as possible. It's also a pretty important thing. A lot of people fail there, and they end up just losing a lot of money. Now, have a predetermined stop loss and exit a position when it hits. Don't keep hoping the position is going to be fine. If you have a certain plan to rolling, you can roll, but eventually you'll have to take a loss if it keeps going against you. So you need to always have a plan of when you're taking a loss. You can never keep dragging a losing position forever, especially if you don't follow fundamentals. If you follow fundamentals, based on the fundamentals, your analysis, you think the price should reverse at some point, it might make sense to roll. I usually just take a loss and just gonna continue on to my next opportunity in most cases. Last point is exit all positions if there's an unusual event taking place that affects volatility and price severely, or a known big event is taking place in the future that you know about. And an example is April 2nd tariffs, obviously. So this is everything we talked about in this video. Hopefully it was useful for you. If you have any questions, let me know. It really comes down to just common sense and just kind of being not greedy and letting fundamentals and the news dictate your decision making, and obviously keeping your position size small and proper stop loss management. Again, if you're interested in mentorship, let me know. I still have a few spots left. Email me and we can see if we are a good fit for one another. Thank you again, and I will catch you in the next one.